Welcome to your custom deep dive. Today we're actually starting off with a massive claim by Warren Buffett. He famously called Benjamin Graham's The Intelligent Investor by far the best book on investing ever written.
Yeah, which is, it's kind of funny because if you hand that exact book to a modern day trader, they're probably going to be completely baffled.
Oh, totally.
Right, like they expect this treasure map, some secret quantitative formula for finding the next massive growth stock, but instead they basically get a psychological survival manual.
Right, yeah. Because it's really not about beating the market at all, is it? It's about surviving your own worst instincts. So our mission today is to break that down. We're going to explain Graham's philosophy in simple language for you beginner investors out there and reveal why his defensive mindset is actually like the most aggressive wealth building tool you can have.
Yeah, and to really grasp how this framework operates, you kind of have to look at the trauma that built it.
Oh, the 1929 crash.
Exactly. Graham didn't just theorize all this in a vacuum. He was completely wiped out in the 1929 stock market crash. He lost almost everything. And that disaster, it just completely inverted his approach to capital allocation.
So he basically went from trying to maximize his upside to obsessing entirely over the downside.
Yes, 100%.
Which, it's like designing a Formula One car, but spending like 90% of the engineering budget on the brakes.
That's actually a great way to put it.
But I have to push back a little, because I get the trauma response, sure. But practically speaking, if you are constantly terrified of crashing, do you ever actually win the race? Like, does prioritizing defense mathematically build wealth better than chasing high yields?
It actually does, yeah. And it comes down to the math of compounding losses. Think about it like this. If you take a 50% hit to your portfolio,
You need a 100% gain just to get back to where you started.
exactly, you need to double your money just to break even. So Graham realized that if you engineer your system to just avoid massive wipeouts, the mathematical gains basically take care of themselves over decades.
Wow. Which is why Buffett's famous two rules, Rule 1, never lose money, and Rule 2, never forget Rule 1, those are direct descendants of Graham's trauma.
Yeah, they are.
But here is my issue, though, with how Graham defines not losing money. Because he draws this really hard, dogmatic line between investing and speculating, right?
He does, yeah. He argues an investment must promise safety of principal and an adequate return, and that has to be based on thorough analysis.
Right. But in today's market, where valuations are so heavily driven by future growth and, intangible assets, isn't that definition a bit obsolete? By Graham's strict standard, buying almost any modern tech stock is just speculating.
Well, Graham would actually argue that buying on the assumption that someone else will just pay more for it tomorrow without an underlying foundation of current earnings is the exact definition of speculation.
So you're saying it doesn't matter if it's the dot-com era or crypto or AI hype cycles.
Exactly. The asset changes, but the speculative mechanism doesn't. You're betting on momentum. You're not actually analyzing a business.
Ah, okay. So he's stripping away the narrative and forcing you to look at the cold, hard mechanics of the company.
Right. And that brings us to how a truly intelligent investor operates in Graham's system. There are three main traits. Trait 1, you act as a business owner, not a paper shuffler.
Meaning you aren't just looking at moving averages on a chart.
Nope. You're calculating cash flows, debt obligations, liquidation value. You have to know what the machine actually produces.
Which sets up the second trait perfectly, protecting against serious losses by demanding a margin of safety.
Yes.
So simply put, if I calculate that a business is intrinsically worth, say, $100 million, I don't buy it for $100 million. I wait until the market panics and offers it to me for $60 million.
Exactly. That $40 million gap is your margin of safety. It's your structural protection in case your math was wrong or a recession hits.
It's a mathematical buffer, but executing that discipline requires the third and frankly hardest trait, right? The willingness to settle for adequate returns.
Yeah, that's the psychological friction right there, settling.
Because when you see a meme stock spike 400% in a week, locking in a fundamentally sound 8% return feels like losing.
It does feel like losing. But chasing those extraordinary overnight returns requires taking on exponential, uncalculated risk. The intelligent investor accepts adequate returns because avoiding the inevitable speculative crash is how you actually win the decade.
So it really just comes down to building a framework that completely isolates your capital from your emotions.
Because the market is structurally designed to manipulate those emotions.
Which brings us to Graham's brilliant Mr. Market metaphor to leave you with today. Imagine your portfolio isn't a digital ticker on your phone, but a private business you share with a manic depressive partner named Mr. Market.
Oh, I love this one.
Right. Every single day, he knocks on your door shouting out random chaotic prices for your half of the business. One day he's euphoric and offering you millions. The next day he's terrified of the news and offering you pennies. If you viewed the market as a manic partner instead of an authoritative scoreboard, how would that change your urge to panic sell tomorrow?